All right, so welcome everyone. Thank you for joining us today. We're here today with Frederic, one of the co-founders and managers of the Alphabee Multi-Arbitrage Fund, and we'll give you a short insight in how the fund is run and what it does. So thank you very much for joining us, Frederic, today. Can you tell me a little bit about yourself, about the firm, and how you guys started?
Yeah, of course, and thank you for having me. So it's a pleasure. So my name is Frederic Guibaud. I'm a director of the Alphabee Asset Management Fund. It's a SICAV-SIF, that's the legal construct. SICAV-SIF based in Luxembourg. It's a fund of hedge funds, but quite specialized hedge funds, and we will talk about that. And we run two sub-funds, which we will talk about today. The Alphabee Multi-Arbitrage, a very defensive and decorrelated fund, and Alphabee Commodity Arbitrage, which is a bit more volatile and which invests into, as the name implies, which invests into commodity strategies. So we launched the activity in 2017, 6.5 years ago, at the demand of our seeder, Peter, who is who's now retired, but who used to be a fund of hedge fund manager himself. So I think that is very important to know for the audience. So he started his first fund of hedge funds in 1994, and that went up to 1.6 billion in 2008. And then from then on, he stopped commercializing or marketing it actively. He was more managing his own money. My associate, David Arno, the CIO of Alphabee, David and we met Peter in 2015 or 16, and he basically said, I want you guys to take care of my hedge fund portfolio. And so my associate, David, has been a director in Luxembourg since, I don't know, since 2009 or so, quite a while ago. So he knows, or he knew, all the Luxembourg ecosystem really well. And our idea and what we proposed to Peter was to create a fund, the SICAV-SIF, and manage his money and our own money. And then if we are successful, attract external capital as well. And this is what we did. So we started out with $15 million at the time, all family money. And today we are at the group level. We are almost, we're at around $110 million in various vehicles. And the family and ourselves, so the whole team, we are a team of 4. The whole team is significantly invested in both of our funds, and we represent still today around 40% of AUM.
Okay, thank you very much. Yeah, because you run two funds. You run the Alphabee Multi-Arbitrage, which we're discussing today, but there's also the Alphabee Commodity Arbitrage, right?
Yeah, exactly.
Okay, excellent. Okay, so to go a bit more deeper into the Multi-Arbitrage Fund, can you give us a short introduction and tell us what the goal of the fund is?
Yeah, of course. So the goal of the fund for Peter, the seeder or the sponsor of Alphabee, was, these are his own words. He told us at the time he wanted to sleep well at night. That was what he said. And so we wanted to create a product that is really complementary to an existing portfolio of a client. We start with the principle that we know that every of our investors, they already have equity, they already have fixed income, they already have private equity, they have real estate and what have you. And it's not up to us to add on another layer of this beta, right, of all these factor exposures to the economy. It's not up to us to add yet another layer. We want to be the counterpoint or the counterweight in a client's portfolio if volatility increases, if financial markets start to get wobbly. We want to be there and protect, first of all, and grow the portfolio no matter the financial regime we are in. And we did that. So we started in July 2017. Now we're February 24. We have seen all kinds of market regimes, from ultra low volatility to super high volatility, spikes, right? Liquidity crises, short vol crises in February 2018, COVID, Trump, Ukraine war, inflation, you name it. I mean, there were really many things that happened, and we have always been positive in every year. I think, out of the top of my mind, in over 80% of all the months we have been positive. The performances were positive in 2018, for example, or in 2022. We were significantly positive. So it's in our investment philosophy to create a portfolio that is decorrelated from the rest of a client's portfolio, and that's also a very nice feature, that will do quite well if and when volatility on financial markets pick up. And as you know, once volatility picks up, financial assets tend to suffer, right? That's almost mathematical, for example, for equities. For us, it's not the case at all. We like it when there is a little bit of wind that is blowing, because our funds are invested in arbitrage strategies in whatever shape or form they come. And we can go more into depth about that. But these arbitrage strategies, their opportunity set will increase when volatility increases.
Yeah, very clear. So it's a real diversifier in a portfolio. That's the main goal.
Yeah, I mean, we think so. I mean, we have. I can show this, or you can send it to your clients or anybody's interested. But we did a correlation analysis. We are decorrelated to standard, let's say, asset classes. We have a beta to equities and bonds of around 0. But again, we will do well if and when volatility picks up. And another feature I would like to stress, it's very important according to us, is liquidity. So we make sure that our portfolios are only invested in liquid strategies, i.e. managers or strategies that use liquid assets that will always stay liquid, right? Because everything is liquid. If markets are at all-time highs and everybody's partying, no problem. But when the wind turns and you have a downturn and there are problems on financial markets, then liquidity can become very important very quickly. And we have seen it happening. We all lived through 2008, for example, or even before that. And we know that liquidity can be very decisive in these moments. So we always want to make sure our portfolios are liquid.
Yeah, exactly. Which is one of the main requirements for our clients indeed. And I've heard that especially the super big, well-known names, Millennium, etc., Brevan Howard, they almost go in the other direction, right? That they become less liquid for their clients. So that's indeed quite an important, unique feature of your fund, that you have monthly liquidity, which a lot of our investors appreciate indeed.
Yes, and just a quick point to Millennium and all these other multi-strat funds. I mean, they're doing an excellent job. There's no doubt about it. But I think what many people don't know is that, indeed, as you say, they have been in such a comfortable position that they imposed long lockup periods to their investors. So first of all, if you want to invest in Citadel or Millennium, well, good luck. I think you need at least 5 million to get in. And then you would probably need around 5 years to get out. Because they can permit that to themselves, and that's what they do. And of course, these funds are very expensive. They can have pass-through costs, which are kind of hidden and no one knows about or no one sees them. But they can have very important pass-through costs, up to 10%.
Yeah. Okay. Yeah, we've introduced you already to some investors who have long decades of experience investing in especially these bigger names indeed. So as we all know, the hedge fund world is a really tricky environment to select who you're going to work with. How do you do your due diligence? Can you explain a bit how your process is around finding and selecting the right hedge funds?
Yeah, of course. I think, or I know actually, that one of our strengths is that and it might sound silly, but it is a real strength, is we know what we want. Because once you really know what you want, then you can focus and you can discard all the rest. So maybe I will start with what we are not looking at. We are not looking at any fixed income, credit strategies, private debt, anything that is or could become illiquid, we don't even look at. We don't look at strategies that have potentially a negative skew or fat negative tails, like cat bonds, for example. We don't look at. We don't look at crypto at all. We don't look at multi-strategy because for the reasons I just mentioned, they are opaque and very expensive. We are also not investing in the typical global macro funds because for us, there's no persistence of return in global macro. It really depends on the managers. Some are very good, some are not so good. Those who are really good can do terrible 1 year later and the other way around. So it's really, really hard to get your arms around it. We're also not investing in I would say, in the typical old school CTA that is just doing trend following. For us, that's not alpha. It's an alternative beta, which and it's a big if you can time it well, all right, you can enjoy the ride. But it's those breaking points, these inflection points, which are obviously extremely difficult and can be very costly. So we try to focus on managers or strategies that are, once again, liquid and that are doing some kind of arbitrage or relative value trades. Some of them are even market makers in their little niche or, in whatever they do. And it's hard, it's difficult to find them. It takes a lot of time because very often these people don't market themselves that much because they know that, they have capacity constraints, meaning they cannot manage billions and billions of dollars, because if they did, they would dilute their own profitability. That's also a very important feature in these arbitrage strategies. They are virtually all of them are capacity constrained. So meaning you can always get out, okay, that's not the problem, but the capacity constraint means you might not get in because the manager will say, no, thank you. I know you want to give me 1 million, but I don't want it because if I took it, I would harm myself because I would actually decrease my profitability and my track record would suffer. And that's inherent in the nature of arbitrage. It has to do with the opportunity set I talked about before. So, maybe if we go really into detail, it would be a bit too much for this call, but we are 3 people. We do a very thorough bottom-up due diligence and sourcing of those managers, finding them in the first place. And we have processes in place, both quantitative and qualitative, to do a bottom-up and then also a top-down asset allocation analysis.
Yeah. And you find these managers all over the world, right? So in the US and Singapore. Yep. So you when we speak to each other, you always very often you're traveling indeed. What was the latest due diligence on-site or research bit that you did?
Yeah, so in the last 6 months, we have been to the US twice, to New York, Connecticut, Florida, Texas. We've been to Asia, to Hong Kong and Singapore. We've been at least twice to London and to Paris. So that's a condition sine qua non for us to visit the manager on site. Of course, before we invest, that's for sure that we have to do that. But then even, when we are invested, we want to catch up regularly. So of course we read all the monthly communication they send out, or research papers or white papers, everything they publish we read, but then we want to be in touch with them. So for example, yesterday we had video calls here with 2 managers that are in the agricultural space in our commodity portfolio, back to back. One was based on 2 different continents. And it was great because you have 2 experts, really experts in the agricultural space. They are doing arbitrage and relative value trades. And it was great to have their opinion and their updates on the fund. So we also check the operational aspects. I would say that's almost the most important part. We do a full-fledged due diligence on operations on all their service providers of those hedge funds. So we check with the administrator, are you really the administrator of the fund XYZ? Yes or no? So, it's a little tick the box and another tick the box. And like this, we have around 100 lines. We tick the box. And only, of course, if a manager passes through those, I mean, nobody's ever going to be perfect, right? Let's be clear. But we need to have a certain level of confidence or high conviction where we can say, yeah, we are confident, this manager is honest, and we know what they do, we understand what they do, and they add value to our portfolio.
Yeah, excellent. Okay, perfect. So we've heard your origin story, your experience in selecting, finding, and also monitoring these hedge funds on an ongoing basis. Then you construct your portfolio. Maybe it's interesting to show that slide if you have it in your presentation, where you see, okay, this is how we construct it, and maybe you can talk a little bit about, on one hand, the alpha that adds, but also how you go about making a mix of the various investments.
Yeah, absolutely. So I don't know if you guys can see that.
Yeah, we can see this.
Yeah. So maybe very briefly, I will answer your question, Walter, but maybe just very briefly, just for the audience to see, because picture is more than 1,000 words. I would like to draw your attention to the graph here below. What does this represent? So we took the average of all the negative months of the ETF on the MSCI World, okay, since the launch of our fund, Alphabee Multi-Arbitrage, in July 2017 until end of last year. Okay, so really 6.5 years. Okay, and the average, believe it or not, if the MSCI was negative, the average was minus 4.66. And in the same months, you see we were slightly positive. So you really see we are decorrelated. And maybe I will just zoom in a little bit if I can do it. On the top left, we are looking at a difficult period on financial markets, namely from September 21 to December of 22. This was really, quite a difficult period. We're not even looking at bonds here, because that would be similarly negative. But if you look at the ETF of the MSCI World, it was down almost minus 14%, and we were up almost 12%. How is it possible? Well, it comes back to this volatility aspect. The volatility made equities suffer, but it was great for us. It was a little bit like a paraglider, or if you go sailing. I know you guys in the Netherlands, you like to go sailing. You need a little bit of wind, right, to move your boat. And this is also what we need in the form of volatility. And now to answer your question, and of course this presentation is available to everybody who's interested. So to answer your question about the portfolio construction, so this is a matrix, a correlation matrix. We are showing here where we compare just the correlations between the different strategies. So we have 15 strategies, and you can see that or maybe you cannot see, I will zoom in a little bit more. You can hopefully see that the correlation between those strategies is very low and sometimes even negative, right? For example, strategy 11 is negatively correlated, statistically speaking, with strategy 6. Now, a statistician would tell you, okay, that's great, but you need a lot of observations to make a valid or statistically significant confirmation or a point. For us, it's even more important to understand qualitatively why these strategies are decorrelated. And that's a very nice feature about those arbitrage strategies. It's actually quite easy to understand. I give you just a few examples. I throw them in here. We are invested, for example, in activist short sellers in the US. They will be short, but they will be market neutral overall because they will hedge their tail risks, for example, with out-of-the-money call options or a basket of other stock names or an ETF to be market neutral. Okay, it's not really arbitrage in the true sense, but it's non-directional exposure, and you will profit, of course, when that stock goes down, right? That's the idea behind it. So we have a short seller in the US. We have, let's say, a specialist in natural gas in North America, has been doing it for 20 years, nothing else, only that. That's what they do. We have an arbitrage specialist in Europe doing dividend arbitrage within European stocks. And we have a manager in Asia doing market making for certain products in less efficient markets. And it's, so I gave you 4 examples right here. And it's easy to understand that these 4, the market maker in Asia, the dividend arbitrager in Europe, and the guys in the US, the activist short seller and the natural gas manager, they are not correlated, right? I mean, it's easy to understand. There's no common denominator. Everybody is doing his little niche thing, and there they are really good. There they are experts, and so it's perfect for constructing a portfolio. And we add value in constructing a portfolio, and this is what this slide here shows you. So the blue line, okay, we took gross returns because it was just easier for us to modelize. So the blue line since October 18 are or would have been the gross returns had we not have an active top-down management. Had we just invested equally weight in all our managers, this is what we would have done. Now the golden line, this is what we did. And we did much better, about 100% better, because it's not equal weighted. It is an actively managed portfolio whereby we look at every strategy from a portfolio perspective and try to time it and try to size it in the right proportion. And that is a lot of experience, I would say, but also we always try to bring in a systematic element just in order to induce more discipline in our construction processes, because a system or the output of a model is without any emotion, right? Without any favor or bias. It will tell you how it is from a quantitative point of view. And this is very valuable because it guides us and it gives it gives an additional input in our portfolio construction.
Yeah. Could that be seen as a risk that you try to time certain environments and therefore favor certain markets? Or is there, as you say, is it more predictable than, let's say, trying to time the equity market?
We are not really trying to time any market per se. I would say our portfolio result is very much bottom-up driven, i.e. it really depends on the opportunities we find on the ground. That's why we chose the bee, by the way, because the bee is on the ground, right? It's going from flower to flower. So we try to find the alpha in all these strategies, going from flower to flower. And if we find a really good manager, we think, wow, this guy has a lot of alpha for whatever reason. And we check and we see, wow, it is decorrelate to the rest of our portfolio. That's what will drive asset allocation. However, it did happen that we did some we had some macro views, but we how can I say, we don't try to be tactical, or we don't try to time the market. For example, what we saw in September 21, when the Fed at the time made it clear that this inflation maybe wasn't transitory, but it was here to stay, and they would have to raise rates, and the market kind of woke up and like, oh gosh, they're really raising rates after all those years, what's going to happen? We decided, or we thought, a higher volatility regime might follow, because the volatility before that has been very low, except for COVID, but even that kind of abated relatively quickly. So the volatility regime was quite low. And then we decided, okay, we want to be more exposed to volatility. And this is when we, from a top-down decision, we went out and sought out volatility arbitrage managers in whom we invested and which indeed did quite well in 22.
Yeah. Okay. Yeah. Exactly. Well, so far indeed it has proven that you add value by constructing the portfolio, especially in these down markets. How many hedge funds do you have on your radar, and how many are in the fund at the moment?
So in both funds, there are about 15 or 16 positions, or around that number. In terms of the list, I mean, we have hundreds, I mean, or even thousands. We have our own database we have created over the years. And we get fed every day. Every day we get dozens of emails. So in a month we get hundreds of emails. And what we do is basically we have developed an algorithm whereby we extract the PDF or even the links they send us, the return and the volatility. We extract it, and then we can make, at least in the first step, we can look at their Sharpe ratio. That's a little bit the starting point, I would say. But then we go, of course, much deeper into detail and look at all the moments of the distribution and at qualitative things as well.
Yeah. Okay. So it's almost a combination of quant screening, and then you do almost fundamental value analysis on what the funds are doing. Okay.
Yeah. I mean, it's even, you can even say it's kind of big data, to be honest.
Yeah.
And we are quite excited about AI, to touch on that, because we think that we have already improved, but I think we can still improve a lot our processes through AI. But again, this is only a starting point. The data or the analysis of the data can only take you this far, right? And then you will have to decide, okay, should we look at fund ABC or DEF more in detail, and why, for whatever reasons. So you need a lot of experience too, and we have that in the team. I mean, Peter, he started to invest in hedge funds in 1988. Yes, you heard right, in 88. That's when he began his adventure in the hedge fund world. So yeah, you also need a lot of experience.
Yeah. Excellent. Okay. Yeah, this is exactly this nicely leads to the final question I had. We see Gerald and I speak to a lot of investors, and if they're invested in alternatives, we often only see one, maybe two local funds, alternatives, hedge funds that they know. Obviously, they don't have the capabilities or even the time to do the same kind of research, due diligence, ongoing monitoring as you have. So that was one of the reasons that we were excited about partnering up with you last year. What would you say to those investors who have just one or two positions in their alternatives?
Well, I would say that an investment in hedge funds, I think if you want to invest in hedge funds, you really need to know why. What is it that this hedge fund or this hedge fund allocation should bring to my portfolio? And it should be really not just saying, I want high returns and lower risk. Of course, that's a part, but which role should it really play? And for example, as I said in the beginning, we have defined that for us. We want to play the role of a complement in any investor's portfolio. If the rest of his portfolio goes down or her portfolio goes down, we want to be there and shine, like we did in 22. We were up 7% with very low volatility of around 2%. So I would say that's the first thing. You have to be really clear what you want. And then the hedge fund universe is very dynamic. It's not that, and this is not what we do, it's not that we buy 15 funds and then we lean back and say, okay, let's go party and let's have a look in 6 months how they did. I'm exaggerating a little bit, but you know what I mean? It's like, it's a constant reassessment, constant revaluation, because what is clear is that the managers who did well yesterday, they might not do well tomorrow, or there's even a high probability that they won't do well tomorrow for various reasons, because there is an alpha decay due to size. We talked about that. Maybe the barriers to entry, right? Like with a company, it's the same. When your barriers to entry in your strategy are low, well, other managers will come in your space and will take away alpha that was all yours before, and they will take it away. So you have to reinvent yourself as a manager, or, and that's the nice position we are in, we have a universe of thousands of managers, thousands. And we also look at fund launches, which is something very interesting also. If it's done right, it's a big if, but if it's done right, a hedge fund launch can be very attractive and of very high value add to a portfolio. So this is what we do also. And I would say, we're not limited to 1 or 2 strategies, but we have dozens of strategies with thousands of managers populating them. So we have a big choice, but then of course it's up to us to do a good job.
Yeah. Perfect. And so far, you've proven that, because every year has been positive. Something that I personally like coming from the derivatives world is that even your Euro hedge fund, Euro hedged share class is not just simply hedged, but it's optimally hedged. So it actually has a far lower drag than usual Euro hedge share classes, which I thought just kind of shows, and that's more my personal note, shows the level of dedication and attention to detail that you guys employ in the fund. So
thank you for bringing that up, Walter. I think that's an important point, because we not only have an experience in analysis, or let's say CIO, but also CFO. Indeed, as you say. And what we have developed is a hedging methodology whereby we can basically, I don't want to go too much into detail, but we can in another call, but we can basically circumvent the use of swaps. So we are not dependent, or at least not fully dependent, on the interest rate differential, which is quite high now, between dollar and euro. So indeed, as you say, we esteem we can cut by half the hedging costs we have in our Euro hedge share class.
Yeah, fantastic. Okay, perfect. Well, Frederic, thank you very much for your time today. I thought it was, again, I've heard it a couple of times, but every time I speak to you, I learn a bit more. I would say to every investor who's looking for real diversification in his portfolio, as a counterbalance for traditional beta with bonds and with equities, this is a fantastic choice. It has proven itself so far, and does a level of dedication to this particular, usually smaller part of your portfolio that's almost impossible to replicate yourself as an investor. So I would highly recommend everybody to get in touch with us, or do a session one-on-one with Frederic to dive into the strategy a bit more in detail. Thank you very much for your time today, and we look forward to catching up soon.
All right, me too. Thank you.
Thank you. Bye-bye.
Have a good day. Bye-bye.